Hi, everyone. Mark Sorensen, CEO and Chief Investment Officer at Royal Fund Management. As we near the end of October, happy Halloween, and go into November and December, we thought we'd put out a market commentary video to give you our opinion on the market and how well it's been doing. This has been an interesting year. The market's done well again, like it did in 2023. I expected that we'd have a couple 5 to 7% pullbacks, and like I've said in earlier videos, some scary moments will come. But like we anticipated, those 5 to 7% pullbacks have been relatively shallow, and we've recovered from them in a relatively short period of time. Welcome to a bull market. This is probably one of the most hated bull markets in a long time. For a bull market to begin during a time of rising interest rates is a little bit unusual. But as we said from the beginning, that we didn't anticipate we'd have a recession because the market started from such a strong point when we had the bear market in 2022. So we've recovered on the basis of the expectation of a soft landing, which simply means that economic activity has slowed, but it does not look like we'll go into a recession. Lately, it's interesting that even though the Fed lowered interest rates by 50 basis points back in the middle of September, the 10-year Treasury has actually gone up by more than 50 basis points the Fed cut. The reason for that are two things. One, we've had some very strong economic news. Not only were they more focused on the economy than they were inflation, because inflation has shown that it's headed towards their 2% target. There's a couple things. One, it seems like the last mile is harder. For example, if you run a marathon, I never have. I imagine that the last mile is very difficult compared to the first 25, right? Well, it was easy to get inflation down from 9% to 3%, but from 3% down to the Fed's target of 2% is going to be a little bit more difficult. So inflation might be a little sticky here, particularly as we've said, we've had some strong economic news that has caused interest rates to move back up a little bit, even though the Fed is in a loosening cycle, and we still expect them to cut 25 basis points either one or two more times before year end. So this has kind of been a Goldilocks scenario, if you will, with interest rates now starting to come down. Most economists do not expect we'll have a recession. In fact, most are in the soft landing arena. And yet still a few that think we could have a hard landing, but most people think the economy is going to hold up pretty well. Let's talk about the elephant in the room, if you will, and that is the upcoming election. Historically, elections have not mattered that much. The market does not like uncertainty, so there's always the potential for some uncertainty leading into the election. But historically, whether it's a Democrat in the White House or a Republican, whether there's a split house or not, in the long run, it really doesn't matter to the market too much. However, as I said, uncertainty can cause some weakness. Historically, if the election cycle causes some market weakness, it should be bought because the market will recover pretty quickly from that. One other thing I wanted to say interesting. I'm going to share my screen here real quick and show you a chart of the S&P 500 year to date. And you'll see back in July, early part of August, when we had the 5 to 7% correction, another little pullback in September, but we continue to have higher lows and higher highs, meaning that stair-step process to better markets. Earnings are good. We're in earnings season right now. Projections for earnings estimates for 2025 have risen. And the other thing that's interesting is that September is historically the worst month of the year. In fact, it's the only month that has historically had a negative return of just a little bit north of 1%. And yet this year, September ended up being positive. October historically is not the worst month of the year, but is the most volatile month of the year. And yet we've had very little volatility as we end October. Now, November and December are historically two of the best 2 months of the year historically. And yet you might remember at the end of the tightening cycle in 2018, when the Fed stopped raising interest rates, the market actually went down precipitously that December of 2018, but recovered the next year. So my point is, even though we didn't go down in September, we weren't that volatile in October, even though September is the worst month of the year and October is the most volatile month of the year, entering into the best 2 months of the year, November and December, does not mean that we still won't have some volatility ahead. The election, again, could cause some volatility. And yet, if we do get a down move, I would expect it to be an opportunity moving forward rather than a reason to panic. So why overall is the market doing so well? Well, it's kind of interesting that the four major tech companies, Microsoft, Amazon, Google, Apple, have spent over $100 billion in what's called capital expenditure on AI, artificial intelligence, in the first half of the year. The expectation is in the second half of the year, they would have spent $125 billion. We are in a new, quote, industrial revolution, which means that AI is something new. The expectation is it's going to create more efficiencies for companies, not only the companies who are building it, but every company will benefit from efficiencies. My expectation is if these companies combined are going to spend over $200 billion in 2024 on building out AI, they would not do that if they did not expect that was going to create revenue and increased earnings over time. So we think this will carry on for a while. We do get a lot of questions about the tech bubble in 1999. Back then, the S&P 500 got to 40 times earnings. Right now, we're trading around 21 times earnings. So an industrial revolution like the internet, the railroad, the car, now artificial intelligence can create a market bubble. But as compared to the tech bubble in 2000, the turn of the century, we think this is more like 1997 or 1998. We think we still have a solid couple years of technology growth, and that the market and earnings will continue to do well. One of the real positive things which makes us more confident about the bull market continuing, again, not without a correction, not without some 5 to 10% pullbacks every now and then along the way. Sometimes we have to back and fill, build a better foundation to sustain the next move up. But we do expect the market to continue to do well based on earnings expectations, interest rates coming down. The consumer continues to hang in there, which is 70% of our economy. I will say one thing about the election, not being political in any way. There is a stock, DJT, which is for the Trump Media and Technology company, which is trading not based on fundamentals, because fundamentally it shouldn't be worth anywhere near what it's trading at. But the stock, since the end of September, has gone from like $12 to over $50. A lot of people are saying that the reason that stock is doing so well is that the expectation that Donald Trump will win the presidency again. The other thing that's interesting is the betting odds. Since 1860, the betting odds have always been right on picking who would win the president, except for 2 times. The interesting thing is the first time was Harry Truman. The last time the betting odds were wrong is when Donald Trump won against Hillary Clinton. So from a market perspective, we're anticipating that Donald Trump will win the election. A lot of concern about tariffs and whether that would cause inflation again. I would just suggest that we've been there before. Even tariffs were enacted during the last Trump administration. There is even some experts that think that the Republican Party could win both houses of Congress. Historically, the market would prefer a divided government because then they can't do anything, right? The House and Senate check the administrative branch, and the administrative branch checks the House and Senate, and not a lot gets done, and the market likes that. But overall, we think that a little bit of volatility here around the election, but all systems go. Interest rates coming down, the consumer doing better, earnings estimates going up for next year, and we are still in this industrial revolution, which could drive the market here for another couple of years before we run into some real overvaluation problems. Lastly, I just wanted to mention, for those of you that know Royal Fund Management more as 401k Maneuver, which is our 401k participant account management program, we rebalance your accounts every quarter. You've done well. Don't forget that you will receive this video but don't forget on 401kmaneuver.com, you can also read our weekly blog there and get some good tips as you head towards retirement. With that, everybody have a wonderful fall, and we'll talk to you again next time. Bye now.